Okay, so now we're talking about monetary policy. So this is just a branch of macroeconomic policy, and it's operated by the RBA, or Reserve Bank of Australia. And the main aim of monetary policy is to change the levels of aggregate demand and economic activity to affect inflation. So their main goal is to keep inflation stable. Okay, and the way they do that is they change the target cash rate, and this affects your cost, it affects the demand, and it affects the availability of credit, so availability of money to borrow. So a brief, very brief summary on how it works. So banks, they have deposits of money from individuals, from businesses, from different entities, right? They have these deposits. And they put parts of those deposits aside, and they do that to meet liquidity standards, and they try to promote confidence. So be like, I have this money, I have all this money aside, it's safe, you can be confident. The rest of that money is given to borrowers, so credit-worthy borrowers, and they repay that money with interest. So the money that you put in your bank account, it's not actually just kept like that. It's actually given to others who want to borrow that money. Okay. Monetary policy, yes, it is pursued for all three objectives, but the price stability, so low inflation, that is the number one objective. So that's your core objective, the underpinning objective that rules the RBA. That flat bit right here. So let's say you look at this part here. At this part, the cash rate was at 0. And that's because inflation was actually negative around that point. So the RBA quickly lowered that cash rate as low as possible to ensure that, inflation is still stable, because it was way too low then. Right now, with inflation being really high, that cash rate is increasing again. So it's at about, I think, 4.85%. I can't quite remember. I think I've got the slide here. And the RBA's persuasion about the direction and levels of lending and investment of the financial sector. Again, it's more like when you speak about it. So when the RBA says, hey, it talks about changing the cash rate, that can actually cause a change in it. So we'll talk about that a little bit later on. Okay, manipulating the cash rate. So the way that the RBA manipulates the cash rate, it's so they undertake open market operations. So firstly, official cash rate, that's the interest rates that banks pay in the overnight money market, so in the money that they set aside. So it's basically like the cost of your money, and it's changed by the RBA to influence your monetary policy. So it's a tool of the monetary policy. And as it manipulates those rates using open market operations, the cash rates change. And as a result, even the banks pass on that cash rate to consumers. So let's say open market operations, the RBA often sells or buys government securities, so government bonds, right? And that's a way of reducing the credit in banks. So if we were going to decrease the cash rate, the RBA buys the government securities, right? So when it buys the government securities, it's giving credit to those banks. So it's giving money to the banks, and that increases the liquidity in the exchange settlement accounts. So it means that the banks or the financial institutions now have more money to lend or to give to people. So downward pressure on the cash rate lowers the cash rate, and then over time the banks usually pass on the lower cash rate to consumers. If the RBA wants to increase the cash rate, then it issues government securities. So it sells those government securities at a discounted rate to financial institutions, right? So when they buy it, they now have less liquidity, so less money that they can immediately let people borrow. and this places upward pressure on the cash rate. So there's limited credit, higher pressure on the cash rate, passed on to consumers, and in the form of higher interest rates. Okay, so like we talked about the budgetary policy stance earlier, the RBA also has its own policy stance. So the current stance is contractionary, so it's over 3%. So the cash rate is over 3%, so the current stance is contractionary. And to achieve that stance, what the RBA did is they tightened or they increased the cash rate. So how did they do that? Well, first, the RBA actually announces that they're going to increase the cash rate. So they say, well, we're going to increase the cash rate, and the reason for this is inflation is too high. Then RBA sells those government securities at a discounted rate. So when they sell the securities, it means that these banks now have less credit. So they have these securities instead, but they can't let people borrow or they can't lend those securities. So we have less credit now. And the money from the banks is transferred to RBA, right? So now with banks having less credit, less money to lend, there's a shortage which causes the cash rate to increase, and this is passed on in the form of higher interest rates. Well, how does that affect the economy? It affects the economy through transmission mechanisms. So before we talk about transmission mechanisms, the policy stance can also be neutral. So usually it's about 3%, or expansionary is below 3%. So the logic is pretty much the same for all of them. Nothing really changes. Okay, so transmission mechanism. So this is how, so the cash rate changes. How does this affect aggregate demand? How does this actually affect the economy? So there's about 5 transmission mechanisms. The ones that I think is easiest to talk about is savings and investment channel. So savings and investment channel is basically about the cost of credit. So let's say the cash rate is higher. So let's just talk about the current situation. So the cash rate is high. It's about 4.85%, I think. And this means that people who want to borrow that money have to pay higher interest rates as well on their borrowing. So let's say they borrow $1 million. Every year, they have to pay 4.85% of that as interest. So that means that the cost of credit or the cost of borrowing is higher. So that reduces the willingness and ability for households and businesses to borrow money from banks. Okay, so reduce consumption, reduce investment spending. Another channel is the cash flow channel. So let's say we've got people who already have loans, right? So let's say I've already got a $1 million loan and suddenly cash rates increasing and I see interest rates increasing as well. I'm like, okay, that's great. Now I have to pay more interest. I have to pay more money as interest, and I now have less money to spend on everything else. So this is basically for people with existing debt. And if the interest rates increase, I have a lower discretionary income. Lower discretionary income means that I have less money in my pocket to spend on different things. Next, money and credit channel, or another word for it is availability of credit channel. Okay, so it's basically how eligible different households or different people are to get loans. So let's say interest rates were 0% like they were before. If I was earning $100K a year, I'd be able to borrow $1 million, right? Because there's no interest rates, nothing of that. But now, if the interest rates are at 4.85% and I'm still earning 100K, the bank will be like, well, are you actually able to pay interest on top of that principal? And if I'm not able to, I will not be able to borrow that money. That means I will not get that loan. I won't be able to spend extra money. I won't be able to borrow money to spend on in the economy. So that's how it affects aggregate demand. It lowers it. Okay, So here are a few more of our transmission mechanisms, and that includes our asset price channel and our exchange rate channel. So asset price channel, that affects our wealth and our ability to spend and invest more money. Basically, it's when, let's say interest rates are really, really high, right? Like they are right now. People are less able to buy houses, and over time those house prices are going to start decreasing, so the property prices will decrease. And suddenly the really wealthy people who own lots and lots of property, they're like, oh wait, my portfolio, like my property prices are going down, and they're going to start feeling less wealthy. And because of that, they also reduce their consumption and investment spending, and then aggregate demand decreases. Next is the exchange rate channel. So that's when the Australian dollar fluctuates, and that's based on the cash rate. So let's say cash rate is higher, like it is now. So I know on the slides it's like decreased cash rates, but let's talk about the current situation. So let's say we have a higher cash rate, right? That means that there's a higher return of investment on Australian financial instruments. So what that means is if people invest money in Australian banks or something, they get a better return. Okay, so this increases the foreign investments in Australia, so more people from overseas decides to invest in Australian financial institutions. Increased demand for Australian dollar, so to invest in Australian banks, they need to convert their foreign currency into AUD. Okay, they do that. There's an increased demand for the Australian dollar, and this increases the value of the AUD, and it causes an appreciation. If we have an appreciation in the AUD, that means that it's more expensive for people overseas to buy our exports now. So less exports, and obviously because of that, there's a lower aggregate demand. But just like budgetary policy, monetary policy also has some weaknesses. The very big weakness is time lags in impact. So while budgetary policy had time lags in implementation because it takes a long time to implement the specific policies, monetary policy, it's really quick to implement, but it takes a long time to actually fully affect the economy. So because of how long it could take to affect the economy, it can actually have a pro-cyclical impact. So pro-cyclical means that, let's say growth is high, monetary policy, because of how long it takes to affect the economy, could even affect the economy after we've come out of a recession, after we've increased our growth anyway, and it could actually have a pro-cyclical effect, and that could be really unsustainable. Okay, broad policy instrument. So what that means is it can't affect specific industries. So budgetary policy can provide subsidies. It can provide subsidies to specific industries which are struggling. So for example, when 2020, when we had the whole pandemic, the government was able to subsidize struggling industries, so such as the hospitality industry. So a lot of restaurants had to close down, but they tried to subsidize them to help them stay afloat during that time. Okay, so it's a really broad, but monetary policy is a very broad instrument. So that means that it can't target specific industries. So let's say some industries were really struggling, some were doing amazingly well. Monetary policy would affect them all the same. So it's not specific, can't affect individual industries or sectors. Lastly, monetary policy, while it's in general, it's good for growth and it can change growth, it's the most effective for inflationary issues, so stuff that affects inflation. Okay, at the same time, the consumer and business confidence can undermine the policy. So even if, let's say, the cash rate is low and interest rates are low, if people are feeling really unconfident in the economy, they're not going to be very willing to go ahead and borrow money. And that can undermine monetary policy, might affect it that way. And again, it's a broad policy instrument, so again, specific industries that are struggling could struggle even more because in general, the economy is doing well. Okay, so finally, let's look at the cash rate. So this is directly from the RBA website. You can hit the link if you want, and you can have a look at it in more detail if you're interested. But again, you don't have to memorize the exact cash rates. 7th of June, the cash rate is 4.1. So sorry, I said it was 4.85. It's definitely not. It's 4.10. I think I confused the 4.10 and 3.85 somehow. Okay, so that is the current cash rate, and it's contractionary. So that's what you should know. You should know that the current cash rate at the moment, it's above 3%. It's contractionary. The government is trying to, or the RBA is trying to slow down inflation. Okay, next, we can see in 2020, the cash rate was 0.1, right? So super, super, super low. Really low cash rate in 2020 and throughout 2021 too. Okay, so as inflation is increasing, the cash rate, trying to tackle that unsustainable increase in inflation, is also being increased. Here is just a quick rundown on what policy mix is. So there's two different policy relationships. So you can have a compatible relationship. So that's when monetary policy, budgetary policy, they're both trying to achieve the same thing, and they do achieve the same thing. So they're complementary. So let's say budgetary policy is trying to increase growth, and the RBA complements that with a low cash rate. So they both work together to increase the levels of growth. If it's conflicting, it means that they're opposing each other. So these policies are going against each other. So for example, if budgetary policy is working to increase growth, but the RBA decides to increase the cash rate, they're working against each other. Okay, another conflict is due to crowding out or crowding in. So because there's limited credit in Australia, if the government is increasing local borrowing to, finance the credit, then there's a higher pressure, there's an upward pressure on interest rates. So interest rates increase. And if the RBA is trying to loosen the cash rate and lower it, it's kind of conflicting with the government. Same thing with the surplus, like crowding in. When the government is, borrowing less money, paying back the money to local accounts, interest rates are lower, because there's less demand for credit. So less demand for credit from the government. And this can actually increase the investment, aggregate demand, and it can conflict with the RBA, which is trying to increase our cash rate. So that's where it can start to get a bit conflicting. There's also different goals. So one of the main goals of budgetary policy is to promote strong and sustainable economic growth. But the main goal of the RBA is to lower inflation, keep it stable. So this can actually be quite conflicting.